Welcome to Your Money with Leo Daprile. I'm Leo Daprile, and each week on AM 570, Dan Rivers and I will talk about anything and everything to do with your money. If you ever have questions, please feel free to call me at 330-533-6936, or you can email me at leo@gemyoung.com. Enjoy the show.
This episode of Your Money with Leo Daprile is sponsored by Grange Insurance.
Time now for Your Money with Leo Daprile Jr. sitting in for Father this morning, and we're brought to you by Gem Young Wealth Advisors. And we want to talk about that topic, life insurance. Oh, you know what? Good morning. How you doing?
Dan, I'm doing well. How about yourself?
When I was about your age and I had just gotten back from my military service, the first guy I run into in town was somebody selling life insurance. And that's about the last thing that you want to run into, right? People go, life insurance? That's way down the path, way down. But there is an upside to buying insurance early, isn't there?
Oh, absolutely. Absolutely. You don't want to wait until you're old and not
gray,
in good
gray
health.
And your hair has turned white. And who's that? Who's that guy? But, I mean, it's kind of a hard thing for people to get their hands around, isn't it?
Well, it's a hard thing to conceptualize because a lot of times we feel that we're immortal, and I'm speaking as a 29-year-old right here, and I have that sometimes. You go to the gym or you go to activities and you say to yourself, man, I'm never going to age, I'm never going to get old, these are things I never have to worry about. But, you know, what I find, Dan, that really helps people conceptualize this better is when they start families, they get married, they start to retire. When they have these big life-changing moments, suddenly people think to themselves, oh, well, maybe I should evaluate what my choices are and what the next 10, 20, 30, maybe 40 years look like. So that's typically when people have that, I don't want to call it the aha moment, but definitely when they start to have this topic floating around.
And, of course, most people know the power of compounding. When you have compounding and you're saving money, it just grows so much more than you can ever do with a catch-up.
Oh, absolutely. You're better off to start when you're 16 if you could.
Yeah, you got it. So life insurance, is that the conversation you have a lot with folks out there?
Well, I do, and today specifically with life insurance, I work closely with my dad on the financial plans he puts together with his clients. And typically what we do is we have like a target. So with the financial plan, sometimes the goal is the couple that's 55 years old, and we have to make sure that we have a life policy in place in case one of them dies. And we need to throw $200,000 or $300,000 in their IRA to make sure that the spouse and the family and the kids and grandkids are all taken care of come retirement time, and they have that investment to live off of, and you can grow. Other times it's conversations I have with my dad and his clients about what do you do when you go to a nursing home? You know, that IRA, that savings you've built, do you want to use that to pay for things like assisted care?
Well, I've had that conversation with your dad, and it is an interesting thing because if you think you can self-insure, there's an area there where you've accumulated enough wealth where you may not have to buy life insurance or long-term care insurance. But then there's another place where if your nest egg is at risk, you may want to buy this. So there's kind of a crisscross there or a tangent, right?
You're exactly right. And we have a general rule of thumb, that typically if you're worth between $750,000 and $1.5 million, that's the most at-risk category of folks for long-term care. So you're exactly right. Once you build, and that's the goal, right? You build enough wealth, you don't need your life insurance anymore, and that's what we tell people. Build your wealth, and we'll cancel your policy if we have to. But once you're worth typically more than that, then you're exactly right. You can self-insure. It's not going to hurt your estate. And with your worth a little less than that, sometimes it makes more sense to play the Medicaid game and use that and leverage that to help you out. But it's that in-between category where we find people really need to have that conversation.
And that's you do that in concert with your father when he is putting together, he and Stephen are putting together plans for your future, the work optional lifestyle. And then you have that conversation about, what if I have to go into a nursing home? And you said that magic number is somewhere between 750 and 1.5?
Yeah, then in terms of your net worth, that's like kind of the most at-risk group. And you're exactly right. I think you have to work with a financial advisor on this. And we do this the other way, too, where I have insurance clients that have that question, and we go with, what my dad's advice on it and manage it that way. But
now, can you combine a life insurance policy with a long-term care insurance policy?
You can, and it's kind of a neat thing out there. It's a hybrid policy is what we call it. But anymore, we used to have to rely on a universal life policy with a long-term care. We call it a rider. which basically means on that universal life, if you go to a nursing home, we can liquidate part of that to pay for that. Nowadays, what we're able to do is we're able to put that on a whole life policy, which the big deal with that is it means a whole life is guaranteed. That's why they're more money, but, guarantees cost money. So we can sit there and say to people, yeah, you can have a guaranteed benefit. Oh, and if you die, we'll pay for your burial, and we have XYZ set aside for that. So it's kind of a cool way to approach it, where you don't have to have that depreciating long-term care policy anymore. Because in the old days of long-term care, you either had to use it or lose it, and every year it cost more money.
So what was wrong with the universal approach? Because as you just described, universal, you're building wealth, right? And if you need long-term care, it takes from that wealth you've built.
Well, I would not look at universal life as building wealth. There's an internal savings account inside the policy. We call it cash value. You can use that. Absolutely. You can use your cash value.
But it's not exactly a cash cow, huh? Not where you're going to make a lot of money.
Well, you just answered your own question, because why would we? And universal lives are an excellent plan. There's a lot of really good applications for them today. But the problem was in the 70s and 80s and even parts of the 90s, folks that didn't quite understand universal life sold it as almost an investment vehicle. And I'm sure you heard it, like you just said, you came home from the military, and I'm sure these guys back in the day said, "Oh yeah, Dan, by the 1999, you'll have hundreds of thousands of dollars." And the problem is they kind of got a little overzealous on what they thought those policies would do. So they're a little riskier, but there's a lot of benefits to them too. So it really depends.
How do you get to the answer that is correct for people?
Well, it really comes down to the individual or the family or the business. Just like my father, we have a FIT meeting, and we call it a needs analysis, where we just kind of sit down and chat. Some people need to protect their assets from long-term care. Some people are 29 and 30 and just had their first couple of children. So everybody's situation's a little bit different. So I think the real key to do this the right way is to really get to know your clients as good as you can.
There is now a guaranteed product out there. Can you talk about that?
I can, yeah. It's through a carrier we have, and it's built on a whole life. So with whole life, as long as the premium is paid for, it'll last for as long as the policy is supposed to. So what's nice about it is you never have to worry about the market changing. That's what really destroyed universal life, is they were selling policies at an extremely high, overconfident interest rate, and the world said, well, we're going to go a different direction. So all these folks, and unfortunately I still see it, that have had these old policies that'll collapse because they didn't perform the way they thought, we can kind of take that concern away. And on this guaranteed product, we can actually return your premium after 10 years, which is what we do with my dad on the investment side of the business. We put these plans in place, and after 10 years or so, if they're funding, if they're at that magic number we've talked about, is where it needs to be, then we surrender the policy, and we take the return of premium and throw it back in their investment. So this is not investment advice, by the way. I have to say that.
Right. Yeah. But again, it's a guaranteed product because you're saying that it's going to be worth X number of dollars, right?
Oh, yeah. That's all stuff that's guaranteed.
And it can be paid for earlier. Earlier, you don't have to continue to pay for it. It can reach that point where it is mature.
Well, you can pay for it in 10 years. You can pay for it all at once. You can pay for it for your entire life. It's really kind of a cool way. It really puts a lot of control back in how you want your plan to go.
Where does life insurance come in with estate taxes?
Well, if you're worth a lot and you have to worry about estate taxes, then a lot of times what you can do is put a life policy in place that's designed to cover the estate taxes. So if you're passing a large sum of money down to your children and you know that they don't make enough right now or they don't have enough to pay for those taxes, a lot of times what folks will do is just put whatever that estate tax will look like, that's between you, your accountant, and your advisor, in place so that when you die, your beneficiaries, in this case your children, could collect that policy.
So you have a high net worth value, and you think, well, there's going to be a big estate tax. You can build in an insurance policy that will take care of those estate taxes.
Absolutely.
Wow.
Oh, yeah.
Nice. What about life insurance? You say it can be put in place to make sure your kids and beneficiaries have the means to pay taxes. But what about using life insurance as a retirement fund?
That's an interesting and very creative way to use it. So for folks that are getting near retirement, or folks that aren't near retirement, really, if you're a married couple and you're both contributing and you're both investing, right? If one of you passes away, your ability to invest is cut in half. So what we can do is project how much money you or your spouse will make over a certain period of time, and tie that into your financial goals. So if, for instance, we're looking at somebody and saying, listen, my dad put this plan together and you need to save $600,000 in the next 20 years, we can write a $600,000 life policy on a 20-year term. So if that person passes away, we'll throw that money into their investment, and that will replace them funding that over the life that they would have lived.
All right, finally, income replacement, putting a policy in place so your family can replace the income without depleting your investment. That would be if you lost someone, right?
Well, Dan, I'm actually really glad you brought this one up because I think this is one of the most overlooked parts of life insurance. Because everybody thinks about, what am I going to do when I die? The nursing home conversation is easy to have. Mm-hmm. But how do you replace feeding young kids? How do you replace daycare costs? How do you replace all of these sports camps and stuff? So this is exactly what a term policy in my mind is a perfect fit for. So if you're a young couple especially and you've just had a couple of children and you say to me, listen, when they're 25, they're on their own, but until then we'd like to pay for their school and their cars and their everything else, then we would put a policy in place that would cover exactly how much you plan on making. Mm-hmm. Padded a little bit just for, unforeseen expenses. And that's exactly what that policy could be designed for. So this, if God forbid that happened, we can just send your spouse that money and they can live off that so that their spouse can continue to raise the children or continue to work and pay for daycare costs.
So for the 25-year-old, term insurance is inexpensive. Can you buy a policy to where that will be a level premium throughout the length of the term policy, or do they always escalate?
Great questions. Most terms should stay exactly the same. I don't typically write anything that escalates like that. Typically, when we put a term policy in place, we want it to be extremely consistent.
And the real story out there is that if you're 25 years of age, you can buy $1 million worth of insurance for how much a year approximately? Ballpark.
Ballpark. A lot less than your car payment.
All right, he don't want to be held to anything here. The other big question is, did Stephen choose you as best man?
Stephen chose me and Lucas as co-best men.
Oh, you're a co-best man.
We had a tag team toast. He actually put a piece of toast in his suit.
Oh, he did?
Lucas did, yeah, in a plastic bag, and he got up and started the toast. He said, hey, I was told that I had to make a toast, so he made toast and gave it to him at the reception. It was hilarious.
Well, Stephen is in sometimes here, too, and he works hand in hand with his father in the investment side of the business, and he married a young lady from Lima Central Catholic, and I had a little conversation with her, and she's doing very well, and Stephen is a married man now.
He is a married man. I love
Sarah,
them both.
I believe.
Yep. She fit right in.
Yeah, that's great.
She fit right in.
And she loves this area, doesn't she?
She does.
She used to come back here and she says, I love Youngstown. So let's build it, baby. Let's do it, right?
I love it. They're in Youngstown. They're sticking around. I got more family staying in town, so all smiles from me.
All right. If you want more with Stephen here, Stephen is on vacation right now. He's on his honeymoon. Congratulations, Stephen. But if you'd like to talk to Leo, he's the Chief Revenue Officer for Gem Young Wealth Advisors. Give us your information, please.
Best way to get a hold of me is at 330-533-7941, or you can email me at leojp@gemyoung.com.
Thanks for watching the video. Be sure to like, subscribe, and hit that little bell for notifications. And also make sure to connect with us on Twitter, Facebook, and LinkedIn. For all of your business news, visit businessjournaldaily.com. For all of your arts and entertainment news, go to afterhoursyoungstown.com.